So welcome everyone to our Investing Essentials webinar. Thank you so much for joining us on your Tuesday lunchtime. It'd be interesting to hear actually. Feel free to pop in the chat whether you're joining us from your home office or whether you're in an office or whether you don't have to go to work today, which in that case, you're very, very lucky. Before we get started, we will just run through a bit of a disclaimer. So just to remind you that Superhero doesn't provide any personal financial advice that considers your personal objectives, financial situation, or particular needs. Oh, sorry, need a bit of water. All investments carry risk, so please consider carefully before investing, and past performance is not indicative of future performance. Now that that's out of the way, what we'll take you through today is some investing basics, some information on diversification and risk management when investing in the share market, some tips on how to build your portfolio over time and the benefits of long-term regular investing, and then some Superhero platform tips and tricks and some of the benefits and features of using Superhero. So to get us started, we thought we'd go back to even before investing in the share market. I know when I first invested, the idea of investing was something quite scary to me, but someone put it really simply and it made a lot of sense to me. So I thought we'd share it today, is that even if you don't invest in the share market or invest in property, we all invest every day in different things. We invest our time, we invest in our education, we invest our money, we invest in people, relationships. And so we're all investors, even though you may not yet invest in the share market. And so that to me kind of made it a bit less scary, because I realized that I do invest and I choose what to spend my time or my money in, and investing in the share market can be part of that if it's for you. And this is just one definition of investing when it comes to investing your money or investing in the share market specifically. But I thought I'd get John, as he's the one that's way more experienced than I am in this area, to give us a bit more info into what exactly investing your money is, or investing your money in the share market specifically.
Hi guys, thanks for tuning in today. I think you're absolutely right. We all invest, and some of the time you may not even realize. The investment that everyone makes is probably on a fortnightly or a monthly basis, and that's allocating cash to a bank account. Putting money in the bank is investing in cash. Cash is an asset class, and if you look at some of the biggest fund managers in the world, they all have an allocation to cash. So putting your money in the bank is the first step of investing. Sometimes you do get an interest rate on which is a return on your cash. At the moment, zero interest rate environment. It's not very high if there is an interest rate at all. But we do start investing very early in our lives. And yeah, looking at shares, that is an investment class in its own right.
Yeah.
And taking that step is it's often a big step, but don't be concerned. You've done it plenty of times before.
Yeah, and I think we can all think about things that we invest a lot of our time and money in. I just had a thought then of how much time and money I invest in my gym membership, for example. Yeah. I'll spend over an hour there every day. I invest quite a lot of money in that. And so absolutely our money should be part of that, and we should dedicate as much time, because it really does have a large impact on our future, just as our health, whether that's physical, mental health, our relationships, it's just as big of a part. And so we should spend time on it and not just let it sit there in a bank account. Yeah. For some people, that is what they decide to do, but it should be a conscious decision, and it should be something that we are consciously doing and thinking about on a regular basis. So we thought we'd run you through just some quick investing trends that you may or may not be aware of. These come from the ASX Investor Study from 2020. So I think this would be higher now, all of these numbers, but at the time of the study being done, 35% of the Aussie adult population owned shares. Now, when you think about how many people might own investment properties, I'm not sure on the exact numbers, but that's quite low really when you're considering the total investment pool. And it means there's a lot of opportunity for people that haven't been invested in shares before. John, do you have any insight around why this number, I guess, was low and might be growing?
Yeah, I think it's important to realize that a lot of I think the number is actually probably a lot higher. If you have a superannuation fund with an industry or retail super fund, those monies are invested in shares. So you're indirectly investing in shares, but most Australians would have exposure to the stock market in one way or another. But being a conscious decision to take some of your savings and invest it in the stock market. Yeah, look, I think it is definitely a growing market, particularly over the last 12 months or so.
Yeah, and I mean, interesting there that 23% of all Aussie investors started investing in the past 2 years. Do you think that has anything to do with, I guess, platform accessibility and education, or what do you think are the main reasons for why there's this sudden increase?
Yeah, I think it is accessibility, and we're proud to be part of that growing trend. But I think as we mature as millennials, and we realize that there's the bank of mum and dad to help in certain families and certain households. I think a lot of us realize that we need to build our own wealth, and we've got the opportunity to start that journey a lot earlier than our parents and our grandparents did. And we're a smart bunch, and we're consciously making that decision to start that wealth creation journey.
Yeah, and I think the beautiful thing about the internet too is that everyone really has access to at least the information to be able to get started, and also to the platforms that enable them to do that in a much lower cost way than they could have done before, and have that choice themselves. I know you started off your career as a stockbroker, and I don't know whether you can provide any insight as to how much it would cost to make one trade.
Yeah, we used to charge, it was a minimum of $125 plus GST.
Yeah, and that's just the fee.
Or 1%.
Yeah.
And when I started as a stockbroker about 15 years ago now, they had just brought the fee down from 2.5%. So that's crazy.
Yeah.
So when you compare that to many players in the States being at zero brokerage, or us being the cheapest at $5 flat fee, it has a pretty big impact on your return.
Yeah, absolutely. Especially when you don't have thousands and thousands of dollars to get started, and you just want to get started for the first time. All right. So when it comes to the share market, when I first started investing, which was not too long ago, I think my perception of the share market was pretty much Afterpay, Woolworths, and Telstra. And I didn't really have much insight into what was actually on the stock market, apart from, I guess, a company being public and me being able to own a portion of that company.
Yeah.
So there are quite a few different options on the share market. Probably the most common, though, are individual companies and exchange traded funds, ETFs, which is something that we focus a lot on at Superhero. Could you give us a little bit more info into the difference between these two types of assets and what they're good for?
Yeah, so I think to keep it at a really basic level, a direct share or individual companies, it's owning a piece of that company. So if it's Afterpay, you own a piece of that company, and you're exposed to their growth, their customers, the earnings that they create, the losses that they make. So you are a part owner of that company, whether it's one of the big banks, whether it's Woolworths, Zip, Afterpay. You have direct exposure just to that individual company. When we look at ETFs buy a whole basket of different companies, all and amalgamate them all into a single share. So if you bought into an ETF, it may give you exposure to 50 different companies, 100 different companies, or thousands of different companies, depending on which one you buy. And it can be a great starting point for building a diversified portfolio. And we do see a number of people signing up to Superhero, creating a portfolio with one or a few different ETFs, and then looking at individual companies and saying, I use Afterpay all the time. I understand it. You're invested in Afterpay. If you're a user, you're invested in using their products. When you look offshore, some of the bigger tech companies, I use an iPhone. You can get exposure to those through exchange traded funds or direct shares. So it really depends on how you're feeling about it, your level of understanding of each individual investment. But it's either an individual exposure to one company or getting exposure to a whole basket of companies through an ETF.
Yeah, awesome. I think a great thing about ETFs for me was getting access to global companies as well, when I wasn't quite ready to invest in individual companies in an overseas market. And probably I don't understand as a customer what some companies overseas might do. I don't understand their revenue models. So being able to go into an ETF, which gave me exposure to, for example, Asia Tech Tigers, that gives me exposure to some of the biggest companies in Asia without having to individually invest in each one. And gives me that kind of diversification, which we'll go into in a minute, diversification across multiple companies, which reduces my risk, I guess, individually picking them when I don't really understand what I'm doing as much. All right, before we do jump into diversification though, I did just want to touch on, I guess, the reasons why people invest. And this is very different for every individual. And every person has a different risk tolerance. They might have a different amount available to invest. But I guess there are two main reasons, and it goes back to that definition of investing. That's you want to come out with a greater return than what you put in. There are two different key strategies, I would say, that people go for normally when investing. Would you be able to take us through a little bit more around the growth versus income investing mindset?
So I think the way to think of growth versus income investing is if we go back to cash. If you put your cash in a bank account, you get paid interest. That's income. You don't expect the cash, the $100 or $1,000 that you put into the bank account to all of a sudden turn into $1,010. That's growth. So if you look at that as shares, a growth share is something that you are hoping for the share price to go up. And you may be wondering, why you wouldn't invest in the share that wouldn't go up in value, but people do invest. And if we look at some of the buy now, pay later companies, they don't pay dividends. So you are looking purely just for growth. They're trying to expand their market share. They're growing their customers. They're growing their earnings, and you want to benefit from that rise in the share price. So that's a growth investment.
And you'd say that's often for companies that might be a little bit earlier on in their journey. They might be a bit younger. They're really looking to expand. And so all of those funds, I guess, that they generate as profit, they're reinvesting that back into the business to grow the company, as opposed to what we'll go into with an income stock. And
a great example of what those companies are tech companies. So whether it's Apple or Tesla or Afterpay or Zip, it's those tech companies that are rapidly trying to grow their business. And ultimately you'd invest in those to enjoy the growth ultimately in the share price. When we look at income investments, this could be something like Telstra or the banks who they've already got very large established customer bases. They've got large established income lines, and they pay big dividends. They typically pay big dividend, and there's tax benefits with franking credits and things. You're not looking for, and even though the banks have all done very well over the last 12 months or so, you don't invest in those sorts of companies to make a killer return in the share price. You obviously don't want to go backwards. But you're there for the dividends. You're there for the recurring revenue that comes off dividends and income.
So I guess to summarize that, a growth stock is something you're probably looking to buy. The share price would increase over time and then you'd sell it for a profit. Whereas an income stock is something you may hold for quite a long period of time, and you actually get regular income through that. Awesome. To quickly explain this, I know it can be quite overwhelming and a lot of information. To quickly explain this, we thought we'd just show a quick case study of what is a traditional growth stock versus an income stock. And so we've chosen Zip and Telstra, probably two brands that everyone will have heard of, most people will have used. You can see here, firstly, in terms of how long the company's been around. Zip was only founded in 2013, whereas Telstra technically founded in 1975, but actually been around a lot longer than that, and in Australians' lives for a lot longer than that. And you can see there that the share price growth, Zip has obviously seen much greater. And I think these numbers were from last week. just to clarify. But Zip has seen quite significant share growth over the last year, doubling in price, whereas Telstra, still 9.29%, which is still quite decent. When you compare it to a 1% cash interest rate, you're still getting decent growth there. But
plus the dividends.
And then when you look at the dividend yield, you can see Zip doesn't have a dividend, but with Telstra, you're also getting that, not that it's guaranteed, but that more regular income there. So just an example there of kind of two different styles of companies you might look to invest in. All right, let's quickly chat about diversification. Now, diversification is a word that I see used a lot online in terms of when anyone has the question, oh, but isn't investing in the share market risky? The answer is always diversification. And it's one word, but it has a lot behind it. It can be done in multiple ways, but would you mind taking us through, John, a little bit around what diversification means to you, I guess, or means when you're investing in the share market?
Yeah, sure. It's that old saying, don't put all your eggs in one basket. And it's exactly right for the share market. If you were to look at, and I can see it on the screen there, the Australian Shares Index ETF, you're buying into the ASX. I think that's the ASX 300, could be the 200, I'd have to check. So you're getting exposure to hundreds of different shares.
Yeah.
So if one of them was to fall out of bed, and there's been a couple, even the buy now, pay later space has pulled back a little bit over the last few weeks or couple of months. It doesn't affect the overall portfolio because the banks have done really well.
Yeah.
So you get this effect of, it's like smooths out the volatility, and it reduces the risk of the portfolio. Where if you are purely just invested in one stock and it dropped 30%, you've obviously impacted your portfolio value. So diversity is very important, and a lot of people, typically over my career, people don't understand the importance of diversity. Having 5 shares is often not diversified.
Yeah.
Putting an ETF in there, absolutely it is. It really expands the overall portfolio to a number of different shares.
Yeah.
So I think the diversification really is important when you're looking at risk.
Yeah.
And it can limit the upside to an extent, but it certainly does limit the downside as well.
And I guess it's back to that whole risk versus reward term, right? There are some people that are comfortable with more risk, but that is more risk. And yes, you may get a higher reward, but you may also lose money. So diversification, I guess, is a tool that you can kind of dial up or dial down and invest in different sectors or include ETFs as part of your portfolio. Yeah. I think a great thing, not to plug the superhero platform too much before we get to that section, but a great thing about your superhero dashboard, which I use all the time, is we've got a diversification dial, which you can actually see it on the screen here now, and it will tell you where you're invested in terms of industries, which is a really, really helpful tool. And you may be okay with investing, quite a lot in tech if that's something that you understand and you're comfortable with that risk. But for other people, you may want quite a balanced view of financials and materials and mining and tech, and you can actually kind of plan your portfolio using that data, which I find really, really helpful.
I think if we just look back at the case study as well, looking at the growth stocks versus the income stocks, when we're looking at diversification as well.
Absolutely.
Like Zip has put on 100%, I think it was over the last 12 months, and Telstra only 9%. Zip has since pulled back 30-ish% maybe.
Since highs.
Since the high, maybe even more since the highs. I think it got up to about 14. It's sitting around 7 now. Where Telstra, for Telstra to fall out of bed, it's 5, maybe 10% downside. Yeah. So you're not going to make as much. You're not going to make 100%. It'll be unlikely to make 100% on Telstra in 12 months, but you're not going to lose 50%. In just a few weeks either. So it's that risk reward, and it's balancing out how much risk you have in your portfolio and how much overall diversification you have, which reduces that volatility. Volatility is
a really interesting one too, because you're right. Even though over time you see them both go up, these kind of growth stocks or stocks that are younger, you can see them go up and down a lot, which I think is something that you have to kind of get comfortable with, especially if you're wanting to invest in these growth stocks. If you check every day, you will see things go up and down. But it's learning to not necessarily get scared by those moves, but understanding that that is the share market, and just balancing that risk and reward.
Yeah.
And being patient and taking time as well, which is what we'll go into in terms of regular long-term investing too, which helps to, I guess, mitigate against that volatility. So yeah, before we jump into talking a little bit more about the Superhero platform and into our Q&A, we did just want to talk a little bit about building your portfolio over time. And there's a saying that's quite often used in investing education, and it's time in the market beats timing the market. You mentioned, John, that, for example, some of the growth stocks, Zip and Afterpay, had some really, really high moments a couple of months ago, but they've actually come back down. And this volatility exists in the market at all times. There are different things that will affect share prices, whether it be in the political sphere, whether it be in the environment, government legislation. It could be a company's earnings coming out. And as individual investors, we don't always have access to that information. And it can be difficult to understand what's going on and to be able to time the market. It's almost impossible as an individual, because we don't have that impact, nor do we have that level of access to information. And we're busy people. Not everyone has the time to spend hours a day researching stocks. What I guess would be not some advice, but what are the benefits of regular long-term investing?
Well, I think, if we look at, sort of go back to the other slide of individual shares and versus ETFs.
Yeah.
And if you look at, let's take Zip as an example. Everyone knows it, and they've done phenomenally well over the last 5 or so years.
Yeah.
Zip listed at 20 cents a share. It got to $14 a share.
Yeah.
So significant growth over a longer period of time. So over 5 years, you've made multiples of your money. Don't even think of percentage returns. It's multiple returns. If you look at Afterpay, they listed at $1. They got to $160 a share. It's
crazy.
Unbelievable.
Yeah.
And if you look at the ETFs, they are more diversified, but some of those ETFs have put on significant returns over time.
Yeah.
If you invested in Zip 2 months ago, you'd be down 50%. And that is taking a really short-term view versus a long-term view. So trying to pick the peaks and troughs in the market is often, you can have a few wins. To get it every time is very hard. But if you look over, and I think it was Warren Buffett had a bet with I'm not sure the exact details of who it was with, but he had a $1 million bet over, I think it was a 10-year period or something, that an index fund would be active management. And Warren Buffett won the bet. He put some money into an index fund or an index ETF, and over time it grew with the compounding returns. Over time, it was worth more than someone who was trying to sell in and out of the market all the time. So I think those buy now, pay later stocks are a really good example. It doesn't always work out that they just go from 20 cents to $14 over a 5-year period.
And I guess that's where diversification again comes in, is not picking just one stock, but having exposure to a number of different stocks over time. And really, again, I guess the benefit of over the long term is that you can consistently add in more as you go. And so there may be times when you're investing at a slightly higher point in the market, and there may be times when you're able to, I guess, buy the dip or get in lower. But it's all about just consistency, putting in money over time. And you can see what this graph actually shows is if you invested $100 a month, which is not very much money. I would argue that most people would probably have around $100 a month left over, if not more, to invest. And $100, it's something that, this is kind of the way I tell my friends about investing, is you'd spend that on a night out, you'd spend it on a new dress, which are all investments in their own right. But why not, put some money and time towards something that can actually start to build your wealth over time? And so if you invested $100 a month over 10 years with a 9.4% per annum return, which we saw there was around what Telstra did last year. And it's really, that is, I think, the average over the last 30 years that the Australian stock market has performed based on a Vanguard study. So if you did that, you will have reached $20,000 in 10 years. And what this graph actually shows is the dark blue actually shows money that is earned and not put in. So the light blue there being that's the money you put in, but you can see over time how much that dark blue or that interest or gain earned over time actually grows, and it becomes a bigger and bigger proportion of your overall investment, which is the benefit of compound interest and time in the market. So it's important to show there that you don't have to start with $10,000. You don't even need to start with $1,000. If you're investing for the first time, you can really start with just $100. And that is the minimum investment with Superhero. So with that, I thought it would be good. I know some people here have traded with Superhero before, but quite a few of you, either you've signed up, but you haven't quite traded yet, or you may have not signed up yet. So we just wanted to run through a couple of the key features and benefits of investing with Superhero. Again, investing is a very personal decision, and you have to take into account what's good for your personal needs. But John, you are the co-founder, you're the CEO, you made the decisions around what Superhero would be and what the features would be. So in your own words, and I guess going through building Superhero, the features that you did and the price points that you did for Superhero.
Yeah, well, going back to where it all started as a broker, we were charging huge fees, which generated big commissions. Yeah, but it was impacting returns. So the whole concept of Superhero was how do we make it frictionless to sign up, easily accessible to be able to invest in shares and ETFs. And we've managed to build a business model that allows us to charge a flat fee of $5 brokerage. Yeah, we're proudly the cheapest in Australia. And what we've also done is we've cut the costs on buying ETFs to zero. So that actually does cost the business money. Yeah. We charge $5 when you sell. So what we're trying to do is we're trying to supplement or remove that barrier to entry for people to start their investment journey. So you can start with $100. You can buy an ETF
with no fees at all.
With no fees at all. There's no account fees. It's easy to sign up. You can fund your account instantly. We give you a BSB and account number. You've got your own virtual cash account on Superhero. So you can fund your account for free. Yeah. You can buy ETFs and really get started. And then as you start to venture out into other shares and things, we do charge you $5. So there's no other fees with it. So it was really just breaking down those barriers to entry. And it's great to see people coming on and starting to build a portfolio, buying a couple of ETFs and a couple of shares and starting to build out their portfolio and build their wealth.
I think that's a great thing about Superhero too is, again, micro investing is a really big thing in Australia, and it's amazing, and it's gotten so many people into investing, which I think is great. But what I love about Superhero is that it does give you that complete choice, that if I wanted to just start with $100 in an ETF that tracks the whole Australian share market, I could do that. But equally, I could also invest in, the latest tech or a new mining company or renewable energy if I wanted to. Yeah. And so, that's what I love most about it. And it's very easy to use. And just, to show everyone there, this is a bit of what the Superhero platform looks like and how you would actually go about investing. So you can see we've got a dashboard there. Our invest screen looks a little bit different to most.
Yeah, maybe I can talk through this one. So the way that we thought about actually making an investment, because a number of people, they don't know where to start, they don't know what to invest in, and when you've got some experience, it can be an easy decision. Yeah. But when you've got 2,500 choices, so what do you do? So what we've done is we've categorized the entire market. So we've broken it into categories. It's like when you go onto Netflix and you want to look at action and adventure movies. You've got a bunch of choices there that you can watch. Yeah. We've done the same thing with the stock market. So we've broken it down into disruptive tech. You can see on the screen different themes. So high interest cash, battery technology, US tech, Asia tech. We've broken it down into gold mining companies, cashless society. There's a whole range of different categories for you to help you identify different themes in the market and where you may want to be invested. Yeah. And it's really helped people making that first decision. If you know you want to invest in XYZ mining, you can search for it and away you go. But it's to help I guess, remove that decision paralysis that,
Yeah.
that people can have.
Yeah, and there are a lot of stocks that people may not have heard of. There are a lot that we have and that we use every day, like Woolworths and Kogan and Qantas, but there are a lot as well that I guess either they're a B2B company or they operate in an industry that we may not be aware of. So the Invest dashboard can really help you discover new companies as well, which I think is really interesting and really amazing. I think one last thing to mention before we go into Q&A is around tax time. I think a lot of people can get quite nervous around because there is tax involved when you're trading shares, and people can get quite nervous around what happens there. But another thing I love about Superhero is that you go into your report section and all of the reports are there for you to be able to download. And at any time it tells you where you're sitting in terms of your gains and your losses. And
this is quite a unique offer that we've got in the platform, again, for no charge. It's free to use. The reports that we generate are similar to some of the ones that we used to generate for clients as a broker, and the fees
how
on
much
those
would you charge?
it was crazy. It was a percentage of their account balance with a minimum per year. And there's a number of companies around that do handle your portfolio and track your portfolio and work out the capital gains and losses and income and all of that. We've built that all into the platform as a value add. So you can get all of your, at tax time, you can hand your accountant or you can send them an email with the PDF or CSV report of all of your transactions, of all of the tax positions, of all of the income. So you're not, scrambling to get contract notes or send them a screenshot or whatever it is. You can just give them a full consolidated tax report.
Yeah, great. Amazing. Well, I think that brings us to a Q&A. I'll stop sharing my screen, and I was supposed to mention this at the start of the webinar and I didn't, so I'm very sorry, Matt. But if anyone is wanting to sign up or is having any issues specifically with their account, we do have the guys on live chat that sit here in our office in Sydney, and they're available from, I think it's 9 a.m. till 5:30 p.m. every day, and they're on right now. So if you did have any questions there specifically related to your account, feel free to go on our website onto live chat. But I'll hand it over to Matt now, and he's going to run us through a bit of a live Q&A with John.
Thanks, Rach. I'll just check if everyone can hear me properly. Let me know if you can't. And thanks everyone for posting your questions. I've been doing my best to work through them. If you haven't got a response from me, it's probably because I earmarked it to ask it live. So just to keep you in suspense. So I thought I'd start with an easy one. What's an index fund? I think there's a little bit of confusion there, with ETF index fund.
So what was the question?
The difference between an
what
ETF
is an index fund?
Oh yeah, so an index fund. Sorry, I thought that when I was saying it. So an index fund is, so there's a number of different ETFs which are index funds. So an index fund tracks an index. So if we use the Australian shares index ETF, that tracks the top 300 Aussie shares as an index. So it buys every single share in the index. Sorry, it buys every share in the index. If you look at NDQ, which is the Beta Shares Nasdaq 100 ETF, it buys all top 100 ETF shares as an index and then tracks that index. So it's buying all of the shares in that index.
And not all ETFs are index funds, right, John? Like there may be some that only invest in a particular area. Like I know there's some robotics and automation ETFs, for example, that would invest still in a range of companies in that industry. But index funds are, I guess, a subset of ETFs that focus specifically on what we call a particular index, which might be the Nasdaq 100, which is a US tech index, or for example, the ASX 200, which is the top 200 companies listed on the Australian Stock Exchange. So index funds are a subset of ETFs that track a particular index, but not all ETFs are index funds. So there are other ETFs that pick stocks slightly differently to just tracking an index. Hope that answers the question.
Thanks, guys. I will just say quickly, the questions are coming through pretty thick and fast at the moment. If you have given your email on this webinar, then we will come back to you after this. Otherwise, you're always welcome to send us an email, hello@superhero.com.au, and we'll come back to you. So we'll just continue with some general questions for now. and
Let's do rapid
participant,
fire.
yeah, 20 questions.
There's a few different ways to, and I think it was what the question was alluding to. There's a few different ways to hold shares in Australia. You can hold them issuer sponsored. That's with a registry. You get an SRN. You can hold them on an individual HIN, which is broker sponsored. So your stockbroker holds your shares on your behalf, or you can hold them via a custodian. The thing about a custody structure is which is not often realized, is there's a huge amount of regulatory capital that needs to be held on the balance sheet. It's net assets. So when you take into account any debt, not that we have any debt, that it's net assets on the balance sheet. So we meet all of those structures. We meet all of those requirements. We are regulated by ASIC, and there are a number of examples in the market that use custodians. There's about $3 trillion in superannuation in Australia. It's, other than self-managed super funds, it's all held in a custody, but with a custodian. If you look at the ETFs that you invest in, all of that money is then held by a custodian as well. So custody structures hold the majority of assets in Australia. They're highly regulated. They're cash backed, and the risk of default in a custody structure, there's no examples of a default by a custodian in modern history, actually.
Yeah. And so really, it's a different structure to having the individual HIN with a broker, but there is no more risk to losing your shares, or if Superhero were to go under, all of your assets are held separately and it would just be transferring them to another broker. We've got around 15 minutes.
Okay, great.
So I can run through a few more.
So next one, I have heard that Superhero is more for day traders than investors when compared to another broker. How would you respond to that?
Look, I think we certainly would attract day traders. We're the cheapest in the market, so you could day trade through one of our competitors at $20 a trade, or you could come to us at $5 a trade. We see a lot of people coming onto the platform, signing up, buying a range of ETFs, a bunch of shares, and that's it. And they're holding it for the long term. So they're not coming back the next month and transacting over and over and over. Certainly there are some day traders on the platform, and we can see that. But the majority of people are coming and buying and holding and setting up a portfolio for the longer term.
And I'd say we've really built the platform for the first time investor and for accessibility and for long-term investing just as much as we have for day trading. And I think that is the beauty of Superhero, is that we work for both. Yes, we are cheap, and yes, that is attractive to people that want to trade often because they're saving on fees. But equally so, we're offering zero brokerage on ETFs for people to get into the market for the first time. And we're no less a platform for those people that are first-time investors and are long-term investors. I know a lot of people, and we see equally a lot of people coming on that are first-time investors to the market in Superhero. And some of the features that we've spoken about today, our low minimums, that zero brokerage on ETFs, the way that our investing dashboard is structured with categories and showing you different stocks in a more visual way, is for those people that are maybe a little bit less experienced, and you're not incentivized in any way to be a day trader on our platform or to trade often. We provide our features regardless of who you are and of how often you trade.
Great. This is one I see quite regularly, so I'm happy to answer this one as well. How do I get my money easily into Superhero? My current banks don't allow that.
Yeah, so good question. So we've actually just rolled out a new feature which gives you a BSB account number. So that is your own unique BSB account number for your Superhero account. So you can do a normal bank transfer to your Superhero account. You'll be able to transfer back to your bank account as well, or you can use PayID, or you can use BPay. So there's 3 different ways now to be able to do it. You've got your own unique BSB account number, your own unique PayID, and your own unique BPay customer reference number.
And you can see all of those options really easily if you go into your wallet section of your Superhero account.
Yeah. I would also just flag, if PayID isn't working for you, it's quite often that your default option is choosing organization ID as the payee. Just make special note to choose email as the payee. That email is your unique account number, and therefore the money will get allocated to you instantly, which is quite cool.
And if you need instructions on that, on our Superhero support page, you can find instructions for different banks around how to transfer with PayID. But yeah, the great new feature is that you can just do a bank transfer using your BSB and account number too, and that information is in your wallet.
Okay, so that gets the easy ones out of the way. The hairy ones will come through now. What is the relation of growth to the share price?
Is in company growth to then how that affects the share price?
Yes, that's how I interpret
Yeah,
it.
look, I think the thing about the stock market is a lot of it is built on expectation. So, and you know, I get it frequently. You know, oh, Macquarie made $500 million. Why did the share price fall 3%? And it's because the expectation was for them to make, you know, $600 million, not $500 million. So it is very much around the expectation on growth. Often, if you do see, you know, strong growth and the share price falls, if they back it up with further strong growth, it's often you often see that share move back up. So typically, if you're investing in a growth stock and there's constant strong growth, you will see the share price move. But it really depends on, you know, it depends on a range of different factors. And I guess the share price is, you know, it'll depend on what growth metric you're looking at.
Yeah.
But if you're investing in a growth company and there's consistent strong growth, you would typically see the share price move higher.
Another question, can I confirm Superhero is launching a superannuation service? If yes, is that available now?
I can confirm we're launching a superannuation service. We actually started Superhero as a super fund that product will be launching very soon. It will allow you to roll your super from an industry or retail super fund into Superhero. It's a regulated, APRA regulated retail fund as well. We pride ourselves on low fees here, and you will be able to invest your super directly into ASX listed shares and ETFs in real time using our famous $5 brokerage as well. So yeah, it is coming soon.
I think it's pretty exciting to be able to have, I guess, your super and your investments really close together. I know as a young Aussie, I'm sure a lot of you would agree that super in Australia is kind of a very passive thing because you think, you know, you can't touch it until you're retired. It's kind of a set and forget, but I think, you know, your super is your money. And when you think about 10% of what you earn every year, that adds up not only over 1 year, but over your entire life.
Yeah.
Again, it goes back to what we were talking about initially is we invest in everything in our lives, and 10% of our income, if someone handed you or said to you, do you want a 10% bonus? You wouldn't say, oh, no, thanks. And say, nah, you keep it for me for a while. You'd say, no, I want to have that money and I want to choose what I do with it. So that is your super, and it's really important to take an active interest. And that's, I guess, what we're trying to do with Superhero is provide that access for people to control their own investments and invest directly in shares with their super.
Yep.
I think this is a really good one to finish on, and I can see questions still coming through. So we will come back to you if we can get you via email. Otherwise, of course, please do send us an email or pop up on live chat and you might be able to have a chat with me as well. I'm really keen to get into the market to buy ETFs, or I'm currently micro investing, but fear is holding me back. What is one thing you would say to someone in my position?
I would say, I'd say jump in. I think the thing about micro investing is similar to what I said about investing in cash, putting money in your bank account. You actually, a number of the micro investing platforms in Australia, and I can probably guess on one hand which one you're invested in. You are actually investing in ETFs. So it's in a handful of ETFs that gives you a diversified exposure to a range of indexes. So, you know, taking your money from micro investing to the stock, directly to the stock market, it is a big step, but
it's not as big of a step as sometimes you think, though,
yeah,
right?
exactly.
Yeah.
It is important to realize that you are actually investing in the same sorts of things, but what you are doing is you're removing a cost layer. So you would be getting charged to to manage that portfolio of ETFs, where if you go direct, there's, and in Superhero's case, there's not even a brokerage fee to buy ETFs.
Yeah. And again, that's why we made our platform minimum $100, because
I thought we'd finish on that one, but
No, go one more.
one more.
oh, you've got one?
Yeah.
Have to go to the list.
Oh, let's get one more. And yes, actually, if you do want to transfer an existing share portfolio, if you've got direct shares already, on our website, you'll see a little banner that links you to a form to download and transfer over, or you can just pop on live chat and the team will be able to help you as well. And there's no fees to transfer in. This is a good one.
Yeah,
Dan.
no, I'm gonna
No?
answer the one there. Will Superhero list on the ASX as well? That's a good one to end on.
That's a good one.
Yeah.
Short answer, yes.
It's that easy.
Long answer, yes. Yeah, look, we just raised $25 million through a capital raise, which we're pretty excited about. So we're very well capitalized, but it will see us list on the ASX, and we're planning for that to happen over the next 12 months or so. So pretty exciting.
And then you can buy shares on Superhero and buy shares in Superhero.
In Superhero, on Superhero.
It's too much.
Yeah.
All right, well, we'll leave it there and let you all get back to work or have some lunch. I think we're going to go have some lunch now too. Thank you so much for joining us, and we really hope it was useful. I think there may be, if I've set it up correctly, a little survey at the end. So I'd love if you fill that out. And otherwise, we'll see you in our next webinar. We're planning to do an ETF series, so look out for that. And the best way to stay informed is if you sign up for a Superhero account. It's free. You don't have to put in any money straight away, and you'll get all of our communications. So yeah, keep an eye out, and thanks so much for joining. And thanks to John and Matt for joining me and having the conversation about investing.
Thanks, guys.
Everyone. Cheers.
See you.
See you
Have a
later.
good day.